miners, they track unemployment rate. They track US initial jobless claims. They love that the initial stages of the recession. There's a breakout here that happened there. One, two, 3. Yeah. So there's a breakout right now. Once usually the momentum breaks down, what happens next is the price actually goes into a correction. Oh my goodness, look at that.
Okay, guys, so today we have Patrick Karim. And I'm very excited because today we will talk about what's happening with the economy right now. We'll talk about the recent economic data, the commodity sector, and certain other opportunities that Patrick sees in today's market. So Patrick, thank you very much for being here.
Hi, it's my honor. Always cool to be on a new show there. So I'm happy to meet you. I know you've had my partner there, Kevin Wadsworth, right, a little while back. So it's all good there.
Thank you very much, sir. So, as I said, I would like to begin by talking about the economy. So we have a lot of news. We had the mess going on with the Fed. We had the job revisions. What's your take, Patrick, on what's happening right now with the US economy, and what are you paying attention to?
Okay, sure. Well, of course, I'm going to share some charts, but look, the economy. So from the business cycle, let me just share a chart. So while I narrate, we'll be able to share entire screen. All right. Oh my goodness, where is it? Okay, here. I could do it this way. All right. This is a post I did for my members, and essentially the economy is set up for a downturn. Yes, it's not you can't 100% say okay, it's going to happen now, but it is set up because I just have to find this chart for you guys. Whenever somebody wants to know, well, where's the low risk entry point is the business cycle. So that means unemployment rate, economic downturn, recessions, negative GDP. When the unemployment rate starts bottoming and turning up, that's when you're more likely to see a recession. That's the green overlay. I could have done it. I'll try to find another chart for you guys there. But every single time that the unemployment bottoms and starts turning up, it's a recession. Had the same thing back in 2020. And look here, we've been after bottoming right here back in 2023. The unemployment rate right now is hogging an important breakout line now because now it hasn't been able to close above 4.2%. So it did it once, twice, 3 times. It's testing it again. So from this viewpoint, the business cycle, once you have peaking in employment and it starts unwinding, that's when you get the great bull run. So this chart, the unemployment after the GFC went super high, and all that period that it unwinds, that was like the bull rally we're in from now, right? From 2009-10 bottom all the way to today. So if this brings to the upside, you're increasing the chances that there will be a recession. Why that's important for people is because recessions, they are often, or practically every single time, they're accompanied with a downturn in the stock markets. What's the depth of the downturn in the stock markets? Well, when you have recessions in a bull era, so let's say from 1980 all the way to 2000s, you had a recession in 1990, stuff like that. The market went down a little bit, but not. It still had the tailwinds of a stock market bull era. But what it does tell you that these important downturns in the stock market can be instigated on these business cycle rollovers. So here we had one. Here's a 2021, and here's the what we're setting up today. It's crazy there. When I hear people, Vlad, say this is a low risk entry for the stock market, the bull run. I'll show you another chart. Right, that is just started. It's kind of, it doesn't make sense there because you're not peaking at unemployment and unwinding, you're bottoming and turning up. And here I have the yields. So here's the 2-year yields. So when the yields, they start turning downwards and they start crashing, it's like the Fed, then the Fed rates, they start doing their rate cutting cycle. They're not doing it just to prop up the economy, for the fun of it. They're doing it because there's a problem in the economy that they're trying to create the stimulus for people to create jobs, et cetera, to borrow more money, to maybe start new businesses, hire. And that's, look where we are now, though. So we had a small breakdown. It's going sideways. It hasn't broken down yet, like in a meaningful way, but it's the setups there. So you're not bottom rates and moving upwards. You're topping rates on the short term on the 2-year yields, and you're starting to turn downwards. And I'll just show you maybe one more chart. Look how stretched we are. This on the top, guys, is the SPX monthly chart since the 1920s. Here at the bottom is the SPX price in gold. When the stock market is stretched from its very long-term moving average, eventually, as soon as it starts losing a rising trend line, or there's a business cycle rollover, like I showed you with the unemployment starting to go upwards, the shorter-term yields starting to turn downwards, you create these places just here, like the 2001 or 2008, where the price goes sideways, rallies up, and then goes maybe again down to create a sideways move for a decade. And eventually, if we do get a recession in the business cycle, if the markets really do start rolling over, you could anticipate that the stock market's probably going to go sideways for many years, trying to let that longer term moving average recapture. And another piece of evidence, just before I try to properly answer your question, is once the stock markets does start rolling over here, like the late 60s, here like the early 2000s, when gold starts breaking out and going upwards versus the SPX, that confirms this like capital rotation event. It confirms that the stock market is going down. They're going to need to do debt destruction, purchasing power destruction to keep the lower the rates, to keep the nominally the stock market afloat, and that fuels even more gold, silver, and uranium, whatever, all the commodities that we could probably touch on later. And that means that once you understand that there's a capital rotation event happening, so while the stock markets, they aren't going to zero, guys, they're going to go just sideways, 30-40% down, then rally up 100%, then go back down. You should be looking at other asset classes that are outperforming, trending upwards. Again, see the SPX going sideways, the gold outperforming, going upwards versus SPX. Same here in the 2000s, stock markets going sideways, gold outperforming. And look where gold is now. It's morphed into existence, this beautiful breakout line. 1, 2, 3, more than 3 touches. So it's a very valid trend line. So it's already starting to outperform. Once you get a breakout, a new uptrend, so higher high, higher lows, it's doing higher lows now. If it does breaks out above this line here, it's going to do a higher high. That's the definition of an uptrend. So the gold versus SPX starting to move upwards. If that's accompanied with the SPX actually starting to lose a rising support line, with the yields crashing, with the unemployment rocketing upwards, then we are at one of these moments where it's going to be like you're going to have to really think hard about where you're going to put your asset allocation, because right now you could be favoring gold, but you should favor even more gold and its family members, copper, uranium, silver, and all that on the onset.
So you made some really good points, Patrick, and I love the way you measure things in gold as well. But if you look at S&P, it is measured in dollars. So what's your take on the US dollar right now and for the long term as well?
Sure. All right, I'll share my screen again. So the US dollar, let me put the DXY. So essentially, guys, the DXY is the US dollar measured versus a basket of currencies, right? Primarily the euro, the Swiss franc, the yen. So over very long periods of time, here's the US dollar chart. It's been going sideways, down, versus other fiats, right? But other fiats also, they're going down, pricing gold. The US dollar is going down versus pricing gold. But the US dollar strength right now is it lost the rising right here. It's right on the support line right there. So, oh my goodness, look at that. Wow. So it's bouncing right now in support. So here you have 1, 2, and with this bounce right here, you have a third reaction for the US dollar. So that's priced in that's US dollar on the monthly chart. Look, essentially the US dollar has been going sideways for many years. Like it's going back, it's at the same value it was back in 2015. The gold chart, it doesn't really, it's influenced by the US dollar, but doesn't really track the US dollar, because there's parts in the 2000s where gold was going up with the US dollar. The gold tracks more the US dollar. I'll do this here. The DXY adjusted for inflation. And if I zoom out here, so here's the US dollar price inflation, right? So now you see the true value of the US dollar. But if I overlay the gold chart on top of that, new price scale, and I'll put that in the log scale for you guys, they're inverses. I could here, I'm going to invert the gold chart, and you see they track the ebbs and flows of the US dollar adjusted for inflation, track much better here. You see here in the 70s, then it goes down. So it's a better macro. If you want a macro driver, like people say, oh, I'm looking at the US dollar, it's going down. That means the gold has to go up. Well, hold on. If there's not enough inflation to offset that, then, but right now, look at that. It's crazy, man. This is, if you're wondering why gold's going up. So remember, guys, this chart here is gold, but with the US dollar inversed. And here it is, the US dollar is plummeting, priced in inflation. So even while the US dollar, like I showed you, is hitting support against the euro. Look at that thing. That's the US dollar there. So it did an important breakdown. 1, 2, 3. Actually broke down right now. So this could be, it looks like this is going to be just a back test. So what could happen, it's a ratio chart, right? So the US dollar could go up nominally, but if there's more inflation coming, more inflation than the US dollar going up versus the other currencies, that chart could actually still keep going down, right? If there's more inflation. If there's less inflation and the US dollar goes down more versus other currencies, it could still go down. So it's a combination of those two factors. And gold just mimics, I could say it front runs because gold broke out before here. Let's say I have this here. Gold broke down out of an equivalent. Let's say gold here broke out. 1, 2, 3. Gold broke out, let's say in March of 2024 right here. And it broke out before the US dollar totally imploded versus inflation. And I have a feeling again that if gold starts correcting up here, I know it's inverse, guys, but if gold starts correcting, then it's kind of a front running US dollar strength versus inflation. And we might have a strong pullback here, even higher. And after that, once gold starts breaking out again, it's like the market telling us, hold on, something's going to happen to the US dollar relative versus inflation. It's probably going to start going down again. But look, that's been the recipe for since 1970 there. That's been the recipe. Destruction of purchasing power, and gold prices that in. It actually outperforms it. So it's not the best. It's a little bit better than just tracking your purchasing power. Sometimes it actually outperforms it. But yeah, that's where we are, Vlad.
So these are great points, Patrick. So let's stay on the topic of gold. We have deglobalization, we have central banks buying gold, loss of trust in the fiat, and possibly US treasuries in a way as well with what's happening around the globe. Things look very bullish for gold. And even at the current levels, gold performed really well. The miners are printing cash at the current valuations. They have really good margins. So Patrick, what would be your expectations if we look at the chart of gold right now for the next 5 years?
Yes. As a chart trader, I went down the route of doing fundamentals back in the days. At the beginning, but the chart is the aggregate of all these bullish newses, because you got to remember, in a bull market, when price is trending upwards, here, let's say in the 2000s, price trending upwards here for gold, I'm sure there were a whole bunch of bearish news here, and the price of gold still went up. And in bear markets here, I remember back here, I think in Greece was defaulting in 2011, and a whole bunch of bad stuff. And it was the greatest arguments ever for gold. Guess what? It was the top. Why? Well, gold was super stretched from its moving average. So here, guys, at the bottom is the distance from that red line. People are used to seeing the way we work there. So that's the red line is the 36-month moving average. Here, the bottom pane is the distance of the price from that. And look what happens when we're stretched. Even I'll stretch it all the way to 70s there. When you're stretched, the price is as soon as it loses a rising support line. See here, right before the GFC, look how stretched we were from that 36-month average. Look how stretched, equivalently stretched. Oh, that was the top. So when even you have bullish news, Vlad, and but the price, the bullish news is happening when the price is stretched, when people have bought much lower and have made one baggers, two baggers, four baggers, eight baggers out of it. They don't care about the bullish news anymore. They're going to use probably that bullish news to exit into strength. So it's very dangerous for somebody somebody on the sidewalk coming in. Oh, I heard my grandma made money off gold, or my friend, he's talking to me about gold. He's talking about the profits he made because he bought lower. And then so I want to make the same amount of money he did, but you got to really take a step back. Hold on. Those gains, he's probably going to want to exit soon, right? Or maybe somebody else going to want to exit. So the more people talk to you about how bullish it is for gold, the best thing I could recommend you is look at the chart, look at the distance from the moving average. Am I stretched from the moving average? If so, I don't care about all the bullish news. You could throw me a billion bullish newses. I'm not interested in entering if I'm on the sidelines and it's just not a low risk entry. Even if the price still goes up, there's no low risk entry. The low risk entries are down here somewhere when you're coiled and tight close to the moving average and you get a price breakout above a cluster of evidence. Sorry. That's a low risk entry here. I'm going to put these vertical lines for you guys. Look at that. Momentum breaks out here, coiled to moving averages. Nobody wants gold for 8 years here. All that bottoming pays. Bam, explodes. Here, stretched. We didn't get stretched all the way up, but we are stretched. And it's not just that you're stretched, but then you lose a rising support line. And guess what happened once you lost that rising support line? I'm going to highlight it here. You lost that rising support line. Gold went nowhere for 4 years, right? 3 years. It went sideways here, 3 years and a half. And again, look, another breakout here. Bam. Descending trend line, breakout momentum, coiled and tight. Nobody, like even me there, I was doing some bearish charts back here. Gold did a false breakdown here. It looked terrible right here, just like it did a false breakdown here. You know, everybody thinks it's going to keep going down. That's fair. You could, or at least sideways, but then it breaks upwards. Nobody believes the breakout. But look, momentum's going up. But look where we are again. If I show it, you're telling me this is a low risk entry? 100% not. 100% not. I don't care if the price goes up to $1 billion right now. This is not a low risk, what a low risk entry looks like. You are stretched from that mean. So this is step one. I don't want to scare everybody, but I have to give people scientific, objective truth. I'm going to just try to draw this as accurately as possible for you guys. Check it out. I'm just going to make it really tight for you guys. Here, 1 touch, 2 touch, 3 touch. We're testing it a 4th time. If that closes below that, the high likelihood is that we're entering a correction, whether it's an aggressive correction via a bullish rising wedge like that there. Price could keep going up in a correction. Correction is time and or price. So it's the price. It could go up, but not as fast as it used to, letting the moving average catch up. The price could go down, letting the moving average catch up. It could just the price go sideways, nowhere, and letting the moving average catch up. So it's a combination of price and or time, just to, let the market heal, reversion to mean, profit takers, all the money that wanted to go in is in already. Everybody's talking about it. So there's no more, everybody that wanted to buy bought. What's left? Sellers. So that's step one. Look, this is getting really close. I could show you some other charts that I'll show you one more to show you how potentially more bearish it is. And guys, look, okay, I got to, because I say there's no low risk entry, people, they're binary in their head. We have to, doesn't mean I say short it, bearish. It works, prices work in stage. So you have uptrends. And then if this, I have a feeling or not a feeling, but from the evidence, I believe that we're close to, some type of local top. It doesn't have to go like this, guys. The step before it plummets is a sideways move. If that sideways move continues upwards, so Stan Weinstein called this stage 2 uptrend, stage 2 uptrend, that stage 3 top, but a stage 3 top could actually be a stage 1 bottom. It just depends how it resolves, right? It could and it's probably going to resolve upwards this eventually. I don't think we're going to go into like a bear market like we did back in 2011, but you need a healthy You need a healthy reset here. You need the price to go down. I don't know, create some type of pattern wherever it is, and then you get a new low risk entry point. I don't know where that's going to be. It could be much lower. That thing could, you know, like maybe it's going to do some crazy thing like that there. So like it did here. You don't know. You can't front run that. And again, guys, this is for traders, even long-term investors, but it's not for stackers. Stackers, they buy their ounces every week, right? Did you ever meet a stacker, a real stacker, Vlad? They're crazy. I had a friend there. He used to bring me to Kitco every week with his paycheck, and he just buy his ounces. He says, Patrick, I don't care about the price. So stackers, they don't care about this chart. They shouldn't care. And if a stacker does care about this chart, he has to really think maybe he's not a stacker, because a true stacker does not care about the price. He just cares about the ounces. So, and look at that. Once usually the momentum breaks down, what happens next is the price actually goes into a correction. Oh my goodness, look at that. It's getting, I'm going to zoom in for your, look at that. 1, 2, oh, it's getting, look, there's no low risk entry. That's 100% guaranteed. Hope, and I'll show you here. Here's the gold chart priced in, let's say, the Swiss franc. It's already started. You see that rising support line, the equivalent one for that I was trying to show you that didn't break down yet for the US dollar. Well, the Swiss franc did. The Swiss franc did, and look what happened exactly after it broke down that rising support line. It's not always like that. But here, since it broke the rising support line, guess what happened to the price? It went sideways. It doesn't have to do that, but the momentum broke down before the price broke down, before. So you wait. Step one, momentum, does it break down? Yes, yikes. Okay, okay, we're losing momentum. I'm not running as fast as I used to. That's telling me I'm not in the optimal macro situation. Forget the news. I'm not in the optimal macro situation where price is exploding and extending away from the moving average. Like I'm just going to try to highlight here. I'm not here exploding. It's the opposite now. Hold on. What? I don't care that influencer A, B, C, D saying that it's going to be a reset. It's going to be all that stuff, guys. That's not going to help you. That's just, it's going to trap you. The price has to agree. And look at that. The price went sideways now for 1 month, 2 months, 3 months. That's a lot of months that are going sideways, while maybe other stuff's going up, like the miners and the other asset classes. So for me, gold, it's still, there's still no low risk entry. So could it keep going up? Yeah, but it's in the 100%, like, and it's about to enter a correction on the monthly chart, which means the correction could last a little bit longer than what people are expecting there.
So you made some really good points, Patrick. I really love that. Now, with that being said, I would assume that you would be interested in the miners right now, or are you looking for a breakout, or are you looking at certain potential levels in gold and silver, or maybe any other commodity?
Yes, well, the miners, they're also stretched. My goodness, it's like look at the miners. This is the gold and silver miner charts from the ASA chart. So people I know, they look at the JDX, which is popular, and nobody's talking about ASA. But essentially, if I could overlay the JDX chart, and I'll show people JDX, new price scale, I'll put log. So here's the JDX there. It tracks pretty much the ASA chart there. Look at that. But the JDX, the data series, stops in 2006. The advantage of the ASA is I get the entire 2000s bull run. I get the 1970s bull run. And I get to show people if you think we're heading into a 1970 situation, the miners is not the place to be. If you think we're in a stagflation area, that's not the place to be for the miners. The miners, they did great. They did fine in the 2000s. So using ASA, it's giving you more historical data, which is critical to understand like how stretched these cycles could be. And look where we are today. My goodness, look at that. Look, I don't know if you have a math background, Vlad, but the data points, most of the data points, they're below that line I just drew. Most of them, they're just statistically, the odds are of us staying above this dashed lines are low. They're much lower. explosions, reversions to mean, exploding from the distance from moving average, coming back. They happen below this line. Once you're here, like I'm not saying that the price stops, but you look at for reset. See here, the price kept going up and up and up for years, right? It doesn't mean it's end of the year, but it's telling you that the low risk entry was not here at this peak here. It was down here. See a base explosion, huge price move in a short amount of time. And even here, the price went, it tried to go up. And then after that, it went sideways. What is that? It went sideways. So even here after this peak here in momentum, gotta let that froth go out. So the price essentially went sideways until the next breakout and went sideways for 3 years. It went sideways. And then look at that. Then once it caught up to the 36-month moving average, then you got the next explosion. Look at that here, the 2000s, 2020. Everybody is silver squeeze. Oh my goodness. Were you there in silver squeeze? It was crazy, man. Crazy, crazy stuff there. It's like when you have, but look, that stuff happens when everybody's happy. Everybody's made a bunch of money. And if that happens, the price is usually super stretched. And look what happened here. Oh, it's got to be like the 1970s. It'll be different, Pat, this time. You'll see it's going to, what happened? Bam, reversion to mean. Look at that. And then the price went sideways, but even worse than sideways. It went sideways, and then it raped you. I'm sorry about the language area. That's violent there. And then after that, then it decided to go up. And the lower risk entries were again, okay, maybe not. Sometimes they move up fast, but they're down here somewhere. And once you get the evidence, you see at maybe here you could have got that maybe down here, but if that moved up too fast, then you get the real breakout up here. 1, 2, 3 touches breakout. But now we were halfway here, distance from moving average. That's the fuel we use. And now we've used pretty much all that fuel there. There's a measure move here. Usually here, that's the pull, flat, tiny flag. Here's the pull, measure move. So classical TA says we've reached a measure move. Distance from moving average telling me we're stretched. We're vulnerable for it could be an aggressive, like an aggressive sideways move where you think I was right in holding, but essentially it just happened to play out that way. Here was the breakdown. So there's no low risk entries for the miners. It's crazy, man. There's no low risk entries for the miners. And I'll tell you why the miners, they're not super in a, miners are good. Oh, what did I do here? So miners priced in gold. Again, you have to price everything in gold. Look historically, the miners, how they perform price in gold. Down, 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 and down. It's like they've lost. I know people, they don't like when I show this chart, but they've lost 95% of their value priced in gold. And even while in the 70s, we know here's 1969, we know that the gold went crazy from 1979 to 1980, right? Gold went crazy, oil went crazy, silver went crazy. The miners, I showed you that chart. I'll overlay you guys the miners chart once again. And you have to look at ASA because you have that data there from the new price scale. So while ASA, I'll put log scale. So while ASA did go up from 1970 all the way to 1980, it did go up. Oh, good. It went up. I made money. Yes. But look price in gold. What happened? I'll measure it here. So let's say that, look at that. The miners, even if they went up, they lost 81% price in gold about. So that means in that stagflationary environment, sure, the miners went up and they had some nice runs, but you should have just held gold or even better, should have just held silver. That's what you should, and much easier. No CEO that could run off with the secretary. There's no frauds. There's nothing like that. There's no risk. Well, there's less risk because it's a base metal, but you're not dealing with humans, right? You're not dealing with companies. Let's say you choose a wrong miner. You don't take ASA. You decide to take another miner because it's a penny stock, and in your head, oh, it's going to 50 million market cap. It's going to be worth like you're thinking in baggers, and you're letting your FOMO there, your emotions, getting the best of you. I'm going to be able to buy a Lambo, whatever. Then you're going for that those higher risk stuff. While you should have just played gold or silver, and you would have win way better. So even here in the 2000s, look at the miners. Here's the miners. Here's the miners from the bottoming in 98. Here 2000 miners go up, all the way to 2007. They got hit hard in the GFC. Then they go up and they do a new high in 2010. But look, priced in gold. Check this out. This is fascinating. Look at that. That's when they peaked in gold, guys. I'm going to try to clean that up for you here. Here, remove that. So the miners, even if they kept going up, they peaked in gold 1 month, 2, 3, 4, 5, like 1 year, 2000. Yeah, late 2000, early 2002. That's it. They peaked priced in gold at the early stages of the bull run. That's when they perform a lot. And I could show you another chart because the miners, they track unemployment rate. They track US initial jobless claims. They love that, the initial stages of the recession, maybe the lower oil prices. They love the beginning part. But as soon as we're in a true bull era where all the other commodities are going up, the miners, they're terrible. They're just, they not price in fiat, they will go up. But right here, this is what's telling me is after this initial burst, look at that. Look at that. They went sideways versus gold for 4 years. And then this makes no sense. They actually went down. Like they lost a whole bunch of value still in the bull era. And here they did their final run and they were never able to outperform gold. So they're back practically at the starting point of the bull era. Oh my goodness. It's like, well, what did I do here for 8 years? I should have just been in gold, I should have, there was no use there for all of this there. They just went nowhere. Or you should have been better in silver, because silver destroys practically everything in a bull market there. It's like when there's a bull era, so when silver's going up and gold breaks out, remember that first chart, that capital rotation event, once that happens, then silver is like the top dog. So the miners, yes, they are in their initial stages right here of having they're doing their bull run, but I'm not putting a lot. Maybe they're going to keep outperforming gold for a little while, but eventually I don't think it's gonna, the trajectory, oh goodness, look at my arrows everywhere. The long-term trajectory for miners is down, 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 and down. I don't know why. Is it they always dilute the shareholders over long periods of time? Is it the impact of inflation or the cost of mining the stuff? There's some deep mechanical thing in there. I'm sure some viewers they say, oh, Patrick, you should have said that. This, or we could ask a chat GPT maybe after and fill in the blanks. But the chart's telling me that it's just horrible there.
100%. If you put like all the junior miners together, there'll be money losing machines pretty much. But I do think there's a point you made from the fundamental perspective. If you are able to look at the company like as a business, if we look at Newmont, Agnico, if we look at the royalty model, some of them are doing really, really well. But that's because the business, the model is actually quite good. So I think if you want to survive in the mining sector, you need to be, to be able to use a bucket approach, especially with juniors. But the bucket has to be carefully selected as well. But with the big companies, it's just treating it as a business and not as a proxy for, 2x gold or whatever people may think.
Yeah. Well, look, at the end of the day, whatever miner you play, price it in gold. Don't price in fiat. See if you're outperforming gold. And if you're not outperforming gold, then you should seriously consider what am I doing here? It's like, this is even Wheaton. Wheaton is one of the best. It's rare you see a miner there hold its ground versus gold like that. And Wheaton is one of the rare ones there, which is one of the better looking charts out there. It's highly liquid. You could get in and out like that. You don't have to worry about it. And it's holding its ground versus gold. So those are rare. Look, it's hitting some resistance right here. So the miners, like, I know people get mad at me and Patrick. Yes, I understand the miners went up in fiat. It's fine. They're in their sweet zone. I'll show you this chart there. This is why the miners are in their sweet zone. Here's remove drawings, reset chart. Here's reset chart here. I'll put unemployment rate. New price scale. Check this out. And I'm going to zoom out. And I'm going to remove all my other lines to clean that up. So update. Okay, here we go. So here are the miners, and look at the unemployment rate. Look at that. Look at that. Shoo. Go the unemployment rate, lower highs, lower lows, drags the miners down. Look at that here. Explosion. The miners, oh, what's happening to the economy? So something's happening. I love it. Okay, economy's having a hard time. I'm going up. I go up in price. Here's a reset in the unemployment rate. I'm gonna just move it. So higher lows here, higher highs. Guess what the miners did? Bam! They track that. Look at here again. Economy is doing great. This is when the unemployment is high and going down. You don't touch the miners. You don't touch any of that stuff. Even gold, you stay away from that. You go in the growth stocks. Economy is doing good. They're going to get the capital flows. Here again, the miners sniffing out that even they were starting to go out before. They kind of almost sniffed out there this economic turmoil of COVID. They went up. Look at that. After that, unemployment rate resets, drags down the miners. Miners going up. The miners are telling me there that unemployment rate is about to something's going to happen there to an unemployment rate there, and they're not going up for the. I don't think they're going up like here for the fun of it. It's just that we haven't had the markets roll over yet, and that is a big piece of the element. As long as the stock market does not roll over, then the coast is clear. You know, it's not a true capital rotation event, and the true gains for the miners, for gold, for silver, they happen after capital rotation event. So we had one here in the early 70s, we had one here in the 2000s. And even if the miners are all the way up here, a true capital rotation event has not happened yet. So the truest gains for the miners, oh my goodness, there's this line here. Maybe we're going to get, I'm just going to minimize here the unemployment rate here. So maybe the next greatest move for the miners will be above a crazy breakout line, right? But again, that's fine. It's good. It's great for the miners. They're going to be in a new bull era, but just make sure you keep measuring it in gold and silver. And the day that they start not trending upwards versus gold and silver, dump the miners. I just don't get it. Just go back to silver there until they start outperforming. That could be some resistance. Yeah, we're approaching we're stretched. Remember, I showed you the ASA stretch from the moving average. There's no more low risk entries there for the miners.
Some really good charts, Patrick, and I love the way you get excited when you find the trend line. That happens to me as well. Some really good points, Patrick. What's your take on uranium right now at the current prices?
The metal or the miners?
I would say the miners, probably the miners.
Okay. Well, yeah, here's the URA. I'll do my setup here, monthly chart. So they broke out. See, the low risk entries, there's not a billion of them. Somewhere here in the 2020 breakout here. Then after that, you got a reset right there. Distance. You see, everybody got crazy happy here in 2021 for the miners. They could do no wrong. And after that, you had a full reset. Then after that, you had a breakout. And here, there's a breakout here that happened there. 1, 2, 3. Yeah. So there's a breakout right now. And the distance from moving average is, it's not super stretch. So we have to see where it sets up its swing low. So this is it. So higher highs, higher lows, uptrend. Now we just got to see where the swing low settles. Hopefully it would settle somewhere like this here. And then after that, you could probably continue upwards. And let that moving average, that distance from moving average reset. Maybe it's going to go down all the way here. So yeah, what's tricky about this breakout, because it's an aggressive breakout. And when I say aggressive, it's because it's a rising trend line. They could get really violent, and or they could produce some false breakouts. So you break out, it's an aggressive rising trend line, and then it just reverts back through, and then it trapped everybody. I rather more horizontal lines where it's a neutral plane, where there's no bullish momentum at all. There's no bullish FOMO, because when it's rising like that, there's still some froth, right? People are still making money. So, but yeah, that's 100% a breakout. And if you want to remove the notion of lines and all that, just look at the moving averages. Are the moving averages, look, I'll do this for you guys. Hide the price chart, remove drawings. Are the moving averages inclining? Yes, I'm above a inclining 12-month moving average. I'm above an inclining 3-year moving average. Hey, I'm in an uptrend. So you could also see it that way, like in a really like rudimentary fashion. Just like here, there was no reason to hold any of those miners here. You're you're below declining 12-month moving average, and look at that. It could last a long time, right? Just like this could last a long time upwards. That moving average, you don't know when it's going to start turning down. People have cycles, they like calling that stuff, but what I've learned is forget that. Just watch a price chart. If the price chart's telling you that um, you're above an inclining moving average, that's mathematical. You're in an uptrend. So the lowest entries, they don't happen often. You could almost see here. Look at that. There's so many details here. When the moving averages are coiled and tight with the shorter term moving average going above the longer term one, that means you have exploding momentum. You have money's coming in like more and more and more. Those are the lowest risk entry points because the money's just starting to go in and it's accelerating. Here it's slowing down. And here you had another shot at it. And here it's starting again to reaccelerate upwards. The only thing I know about these things is the further you go along, the less and less these, you see here how they shorten the length there. It's like, sometimes it's kind of sad because you don't trust the original breakout. Then, okay, sometimes you might not even trust the second one, but my two favorite entry points are the initial breakout and the first continuation breakout. After that, I'd rather look at another instrument where it's just starting to do here, or it's at its first correction, first important correction that ends, because eventually the further you go in, you might get four or five of these, 3, 4, 5 of these in a long-term bull market. You don't get tons of these. So one of these eventually will fail, and it will be the top that will lead to a downturn. So we're not there yet, but yeah. So they're in that trend. What can I tell you? They're fine. Yeah, I think even energy fuels there. I think I looked at it this morning there with Kevin. Energy fuels. Look at this thing there. I'll put the price back. Is that a breakout? Yeah, it looks like it was a breakout here for energy fuels. Higher lows, higher highs, and if it's able to go above, it's probably hitting some resistance here. Yeah, that's why it's halting the congestion zone. And if it's able to start doing higher highs above this peak here, like in a more meaningful way, not like just tiny like that, then you got a new uptrend on your hands, right?
Again, really, really good point. And Patrick, what would be your views on the portfolio structure in the current environment? So what would you be paying attention to? What asset classes you would be more interested in if you are interested in having a balanced portfolio?
Yes. Well, right now, it's funny you say that there because we have that there on the website, a dynamic portfolio manager, and essentially, just from a bird's eye view, it's like the classic portfolio where you have gold, stocks, the SPX, cash, shy, the short-term treasuries, and the long-term bonds, the TLT. And right now, you'd probably be 50% gold, maybe 33% SPX, and the rest or cash. And I don't think we have any bonds allocated right now, but gold is still favored over SPX, but SPX is still fine right now because they're both in bull markets. But as soon as the SPX rolls over, it's going to be when the SPX rolls over, it might be converted to cash and even gold a little bit to cash. But once, if ever the drawdown in gold and the drawdown in SPX stops, so like let's say a capital rotation event area where maybe they both get dragged down, on the onset of that, it's practically the SPX is going to be very low, and it's going to be practically that 50% of the pie for gold is probably going to be even higher. So like gold has been in a bull market since 2019. It's like it's just doing its thing there, and SPX also is doing fine also. So, but eventually it will probably the pie chart should be even more favoring gold there.
So just before we wrap up, Patrick, I like to have this question for the younger audience. If we have an individual who's still at the beginning of their wealth building path, and they have so many choices, they have the Nvidias, the Bitcoins, the commodities, trade and investing, what advice would you have for that individual and how they could, evaluate and how they could start their wealth building path the right way?
Well, that's a great question. Everybody, they should first really look in the mirror and say, what kind of trader are they? Are they in it to scalp, like in and out every minute? Are they in for day trade, hold a few hours to a day? I don't know. Then are they there for swing trading? Do they want to hold over a weekend, a week, 2 weeks? Or are they a position trader? They want to hold many months? or investors many years, or are they stackers? So that's step number one. Before you do any trade, understand what type of trader, what's your emotional profile. Some people, they want to be investors, but they can't even tolerate a 2% drawdown because they're on Twitter and it's going down. So, okay, hold on. You want to be an investor, but you don't have the mental fortitude yet. You could build it up there by not looking at the daily news and stuff like that. Or some people, it's the inverse. They're investing, but they had the itch to trade, right? They're ready. They want to, they don't want to ride these huge drawdowns. They want to go in and out and have, so step one, do that. Once you do that, you could select the proper time frame, because there's actually time frames. Like when I show you the monthly chart, that's more for position traders, people who, when we go in the trade on the monthly chart, you're going to hold it for 6 months, a year. People love that. It's like less transaction fees. Don't have, you check one per month. You check on the chart. That's another thing. How often do you want to look at your charts? And signals are given on closes, for at least for the entries. So if you want to check your charts just to one per month because you have you're a busy guy, well, it kind of settles you into, choose a monthly time frame. You check it once per month, and that settles you as a position trader / investor. But if you want to check it every week, then you go on the weekly time frame, and that permits you to be a swing trader, and you're able to go in and out more, because every week you're going to say, okay, did I get a confirmed buy breakout? Yes, good. Did I get a confirmed sell? Yes. So that's probably be the step one. Match your emotional profile with your trading, and the rest, I think it's probably going to fulfill itself, because all you have to do is like we did today. You're going to use ratio charts. Okay, is the SPX outperforming gold on the weekly time frame? Yes. Okay, then I know I have better odds of playing that instrument instead of the other one, and then you go from there. But step number one, emotional profile, because emotional capital is a real thing, and people will lose their emotional capacities before they lose their physical cash. Because I don't know if you play poker. When you go on tilt, man, I don't care how big a stack you are, you lost a big hand there. You're going to try to get it back the next, and then it's just like the game plan goes out the window. It's just horrible to watch there. Like I've been through that there. So, yeah, that's probably my biggest piece of advice.
That's a really good one, Patrick. So these are all the questions I had. Thank you very much for being here, sir. I hope to have you back.
Thank you.